Picture this. You stumble across a stock trading at just 5 times earnings. I mean, it's cheaper than 95% of the market. It's got a rock-solid core business, and the company is aggressively buying back its own shares. Sounds like a total dream, right? Well, what if I told you this exact same stock scores a definitive failing grade on Warren Buffett's investment framework? It's basically an investor's dream and an absolute nightmare rolled into one single ticker. Welcome to our explainer on White Mountains Insurance Group, ticker WTM. Today, we're unpacking Wall Street's most confusing stock. It's a company that's simultaneously a deep value bargain and a terrifying value trap, depending entirely on who you ask. We're going to break down the hidden red and green flags the media is completely ignoring right here, right now.
Okay, let's dive into this and look at the sheer scale of this disconnect. Over on one side, you have a valuation that makes value investors literally salivate, a 5x price-to-earnings ratio. But then, on the flip side, you get a 38 out of 100 on the Buffett Fit score. Guys, that's a total failing grade. The disconnect here is just mind-bending. How can a stock look like the bargain of the century and a fundamental disaster at the exact same time? Well, to understand that, we need a little context on what we're actually looking at.
Take a look at this number right here, 11,700%. Yeah, you heard that right. That is the historical return WTM has delivered since its IPO back in 1985. This is a $5.1 billion holding company that has handsomely rewarded patient capital for decades. So it's absolutely not a flash in the pan. But, as we all know, the past doesn't always predict the future. And right now, the waters are incredibly muddy. Let's see how this all builds on the actual structure of the business itself.
Just real quick, before we rip into the numbers, here's what this holding company actually does. They operate across 4 really diverse segments. You've got ARC and WM Outrigger handling property, casualty, and specialty insurance. And we are talking everything from aviation to literally space insurance. Yes, actual space insurance. Then there's HG Global. They manage municipal bond reinsurance. You've got Kudu, providing capital solutions for asset management firms. And finally, Distinguish handling property and casualty distribution. So it's this massive, highly diversified insurance platform. Section 1. Antithesis. 7 major warning signs. The bear case the media is ignoring.
We're jumping right into red flag number 3 because, honestly, it's the most vital one to understand. $668.8 million. Over the last 12 months, WISM's earnings included this massive one-time gain. And why does this matter so much? Because it artificially deflates that 5x PE ratio we were just looking at. It makes the stock look way cheaper than it actually is based on its repeatable operating performance. That crazy low PE, it's largely an illusion. If you strip this out, the normalized PE, which is the valuation based on their actual everyday business, tells a very different story.
Which brings us right to red flag number 4. Look at this comparison. While that PE ratio suggests the stock is dirt cheap, a widely cited discounted cash flow analysis estimates the fair value at just $1,433 per share. Now, with the current stock price sitting around $2,149, this cash flow perspective is telling us the stock is actually nearly 50% overvalued. So you have to ask yourself, is it cheap at 5x earnings or wildly expensive based on actual cash flow?
And this brilliantly illustrates red flag number 1, the valuation black box. WTM holds some pretty significant level 3 investment assets. Now, if you aren't familiar, these are financial assets with absolutely zero observable market prices. Their value is determined strictly by internal management models and assumptions. As the quote here points out, these unobservable assets can dominate earnings and suddenly reset results. That is a massive genuine risk to earnings quality, mainly because you, as an outside investor, literally cannot independently verify these numbers.
Let's rapidly chunk through red flags 2, 5, and 6 here. First off, earnings are just incredibly volatile. I mean, WTM swung from massive profits to a $27.2 million net loss in Q1 of 2026. Second, a whopping 42% of their risk factors are legal and regulatory. And this includes a terrifying IRS tax landmine regarding related person insurance income. Under this, shareholders could actually be taxed on income they never even received as dividends. Yikes, right? And finally, the moat is practically non-existent on an operational level. They have a return on invested capital, which is basically the profit they generate from the cash they invest in their own business, of just 2.9%, alongside a gross margin of just 0.6%.
So when you aggregate all of that, the wildly volatile earnings, the unobservable black box assets, the super low ROIC, and the total lack of operational pricing power, you get red flag number 7.
WTM passes only 4 of the 9 criteria in a Buffett Fit framework, resulting in an abysmal 38 out of 100 score. Basically, if you're seeking a classic quality compounder with predictable earnings and a wide moat, the data here emphatically tells you to run away as fast as you can.
But wait, don't write this stock off just yet. Section 2, Thesis, 7 massive hidden strengths. The bull case hiding in plain sight. Let's look at what the bears are completely missing.
Green flag number 1. Yes, we absolutely know there's a one-time gain clouding the numbers. But on a pure multiples basis, WTM is undeniably trading at a massive discount. At roughly 5.1x earnings, it is literally half the valuation of the U.S. insurance industry average of 10.9x. And it's just a fraction of the broader market's 18.7x. Even if you adjust for the noise, that is a really steep discount to its peers.
Green flag number 2 proves that the core business is actually working beautifully. Look, in the insurance game, the combined ratio is everything. A score below 100% means the company makes money strictly on underwriting before they even touch their investment income. Well, WTM posted an 83.9% core combined ratio in Q2 of 2026. This means for every single dollar of premium they collect, they only pay out 84 cents in claims and expenses. They are absolutely minting money on excellent underwriting.
And that operational strength translates directly into a total financial fortress. Let's group green flags 3, 4, and 5 together here. Remember that nasty Q1 loss? Well, Q2 saw a massive rebound with net income surging to $199.5 million. Plus, they operate with literally zero leverage at the parent level and a tiny 14.9% total debt-to-equity ratio. And management? They showed massive confidence, aggressively buying back $191 million of their own stock in Q2 alone. But the ultimate deep value signal? The book value sits at $2,258. With the stock trading around $2,149, you are essentially paying just 95 cents for every dollar of net assets.
Wrapping up our green flags are 2 incredibly rare traits for generational returns. While WTM totally failed the Buffett test, it actually scores an A grade, 81 out of 100 on the Peter Lynch framework. It is a prime growth at a reasonable price or GARP candidate due to some massive trailing earnings growth. And despite all that earnings volatility we talked about, the stock itself is incredibly stable. It has an ultra-low beta of just 0.30 to 0.32, which means it is less than a third as volatile as the broader market. It rewards patient capital without giving you those heart-stopping daily swings.
Section 3, Synthesis, the legendary framework showdown. Graham versus Lynch versus Buffett versus Munger. Let's see what happens when the greatest investors look at the exact same data.
Now, what's really interesting about this slide is how perfectly this matrix captures the contradiction. Look at Ben Graham, the classic value investor. He gets a 43% score. He's intrigued by the low multiple and price to book, but he'd be heavily wary of that one-time gain skewing the numbers. Then you have Peter Lynch giving it an A grade. He absolutely loves the massive growth sitting there at a 5x PE discount. But then look at Warren Buffett and Charlie Munger. Buffett passes completely because of the low return on invested capital and the earnings volatility. Munger also passes because the business model is just overly complex with those unobservable assets, and the competitive moat is way too thin. It's the exact same data, leading to totally opposite conclusions depending on your philosophy.
Section 4, Final Verdict and Actionable Takeaways. What this means for your portfolio. So, the crucial point is this. WTM is cheap for a reason. It has complexity, earnings volatility, and a really thin moat. But for investors who actually understand the nuances of the insurance business and have the stomach for that volatility, this deep value, GARP-friendly stock might just be a massive hidden bargain. But you absolutely must know what you are buying and why. You cannot rely on media hype or top-level metrics alone.
Which leads us to 3 actionable steps so you can take control of your own due diligence. Step 1, go read the 10K. You really have to understand the specific level 3 assets and the reality of those RPII tax risks. Step 2, do the math yourself. Strip out that $668 million one-time gain and calculate the normalized earnings so you actually have a realistic PE ratio. And step 3, decide what kind of investor you actually are. Does your personal philosophy align more with Warren Buffett's need for a wide moat or Peter Lynch's eye for growth at a reasonable price?
And that is the ultimate question I want to leave you with today. Are you a Buffett investor holding out for a simple, predictable, high-return business? Or are you a Lynch investor ready to dig through the complexity of WTM to grab massive growth at a deep discount? If this explainer brought you some clarity today,
Make sure to hit that like button and subscribe for more deep dives. And definitely drop a comment below letting me know your investing identity. Are you Team Buffett or Team Lynch? I read every single comment and I'll be responding to the top insights. Remember, this is an explainer, not financial advice, so always do your own research. See you in the next explainer.